Oh, wow. Look at that gorgeous day that is dawning here in South Florida. Here I am, Kenny Polcari, your host of the party, and today is Tuesday, October 11th, 2022. And what is it that we need to know to get your day started, other than it is an absolutely beautiful day here in South Florida. It's about 75 degrees, probably going to 85 degrees on the day, no humidity. So the week begins once again on a sour note as stocks move lower. The Bank of England warning of UK financial instability, and that's a problem. Jamie Dimon is warning of some serious headwinds ahead for the U.S. and the global economy, and investors are awaiting inflation data and the start of earnings season, along with the FOMC minutes on Wednesday. And semis continue to get absolutely smashed. And what are we having for dinner tonight? We're going to have the Sicilian TBone. Absolutely delicious. All right, so in this morning's note, I did put in the market-wide circuit breakers just so that everyone's on the same page. It's not an alarm. It's just saying here's what has to happen so everyone understands. The S&P would have to fall 7% or 252 points to trigger the first trading halt. It would have to fall a total of 469 points to trigger the second trading halt, which would be a 13% decline. And then it would have to fall 722 points or 20% of last night's close to halt trading for the day. That's it. Now everyone knows it's just to put the information out there. It's not suggesting that today we're going there. Okay, so stocks continue to trend lower, right, as the week started. The NASDAQ making a new 2022 low, falling 110 points or 0.7% to end the day at 10,449, which is that two-year low. It left investors and traders and analysts and algos all on the edge of their seats in sympathy. The Dow gave back 94 points or 0.3. The S&P fell 28 points or 0.7%. The Russell lost 10 points or 1%, while the transports bucked the trend, rising by 10 points. All of the indices remain above their 2022 lows with the exception of NASDAQ, leaving many to wonder, is this it? Are we getting to the point of no return? Are we about to circle the drain? Yesterday was a bank holiday in the U.S. and there was no eco data to report, nor was there any bond trading, so it was expected to be a muted day. In the morning, we heard from the Bank of England, right, who's trying to stay calm in their brewing economic crisis, and then we got Jamie Dimon of JP Morgan to fire the shot across the bow, warning of dire consequences for the global economy in the months ahead. Those, plus the CPI, the PPI, the retail sales, the coming Fed minutes, and the start of earnings season, all weighing on investors' minds as everybody tries to price in what they think the risk is. A hotter than expected CPI and PPI is going to force the Fed to make sure and push rates up by the expected 75 basis points and consider continuing to raise by 75 basis points in December as well. And that is a change from the narrative that we've heard for sure, and that is part of what's ailing the markets, the continued confusion. Wednesday brings us the latest FOMC minutes, and many are now suggesting that those minutes will provide some new insight, which I don't agree with, into what the pain point is. Remember, JJ already raised the pain threshold from 4%, 4.25% to 4.5% to 4.75%, suggesting that 4.6% was the desired terminal or neutral rate. Recently, there's been some suggestion that even that may not be the real terminal rate, leaving some to speculate that St. Louis Fed President Jimmy B. And his intimation of a 5% rate is really the terminal rate. What's clear, whether anyone wants to believe it or not, is that the Fed officials are resolutely hawkish. They have not veered off course yet, leaving many to speculate that now the financial market's volatility or the threat of a recession is going to deter them from raising rates. Again, I think we're already in one. It's just that we haven't hit the bottom yet. So it's not a matter of if we're having a recession, we're in one. It's just how deep is it going to be. Then Jamie Dimon of JP Morgan fame, during a European interview, said that there are very, very, very serious mix of headwinds that will likely tip the U.S. and global economy into a recession by mid-2023. He also added that the S&P could fall another 20% from here if the Fed did not engineer a soft landing. And again, I told you months ago that soft landing should not be used in the same sentence when referring to the current economic environment. And you can bet that another 20% move lower from here is going to be much more painful than the first 20% that we already got so far this year, noting that the S&P is down just about 22% year to date. Let me be completely clear. There is no way, no how, that the Fed can engineer a soft landing now. We passed that point, and we are now at the point of no return in terms of a soft landing. All you have to do is go back and listen to the 1974 classic by Johnny Bristol. Who remembers him, right? He was one of those one-hit wonders. Hang On In There, Baby, right? That's a great song. Don't be afraid. I know how you feel. We've almost got it made. I can't wait until we reach that sweet moment of surrender. We're going to hear the thunder roar and hear the light and feel the lightning strike. Although my God tells me that unlike that song, when we reach that moment of surrender and hear the thunder roar and feel the lightning strike, it's just not going to be the same. Take a moment and revisit that Baby Boom classic. You can find it on YouTube, right? Johnny Bristol, Hang On In There, Baby. It's such a great song. I got it now in my head. It's just been spinning around since I listened to it this morning. Okay, so it's time to move on. Recall, back to Jamie Dimon for a minute. Recall that Jamie also predicted an economic hurricane back on June 1st, causing the global market strategist, his global market strategist, Marko Kolanovic, to publicly challenge him by basically saying he was overreacting. There was nothing to worry about. The Fed would navigate a smooth, soft landing with little risk at disrupting the economy or anything. So I say, Marko, how'd that work out? On June 1st, the S&P stood at 4,100. Yesterday, it closed at 3,600. It's down 12% from that day and likely going lower in the days ahead. And then, to add even more confusion, as if we needed any at all, at 1:30 p.m., Lel Brainerd, the vice chair at the Fed, came out and suddenly appeared to make a case for caution, leaving the algos confused. Was she advocating for a pivot? Was she floating a test balloon? Was she taking the temperature of the markets? I mean, there's always this idea that the Fed pivot is coming and they won't have the stamina to maintain the course. And you know what happened then? You can imagine. The S&P, which was sitting right on the lows reached on September 30th at 3585, suddenly shot higher, and the algos interpreted her comments as a shift in position. Think pivot, ridiculous, but that's what they did. All you have to do is look at the chart. The S&P did a 180, and it rose more than 1% in 30 minutes as the algos tried to compute what she meant. In the end, investors, though, decided that her comments did not represent a change in position, and stocks ended the day, like I said, in negative territory yet again. So, more confusion created by algorithms. While the tone at the end of the day was not a disaster, it is clear that trouble is brewing, right? And that we surely is going to keep the pressure is going to stay on. Overnight, we saw stocks in Taiwan, which was closed on Monday, take an absolute beating. The TAIEX index fell by 4.3%, taking that market down 536 points as the algos bailed on the semis after they weighed the impact of the new Biden rules on their star performer, Taiwan Semiconductor, TSMC, which itself fell by more than 7%. Taiwan Semi is the world's largest chip maker, and the idea that Joey has now put export controls on China's ability to buy and manufacture advanced semiconductors used in military equipment is causing that sector to rupture. Note the SOX ETF, right? SOXX. It's down 12% since rumors of that action began only last week, and it's down 45% year to date, taking U.S. names like AMD and NVIDIA down 62% year to date, and Intel down 55% year to date, and they look like they're about to go even lower, if you can imagine that. European stocks are all lower by 1% this morning after the Bank of England warned of this material risk to UK financial stability, extending their purchases of government bonds known as gilts, which was supposed to end today. They extended that till Friday. They also included index-linked gilts, where the payout to the bondholders is benchmarked to the UK retail price index, and we know what that's done. In their announcement, they actually said it this way: the beginning of this week has seen further significant repricing of UK government debt, particularly index-linked gilts. Dysfunction in this market and the prospect of self-reinforcing fire sale dynamic poses a material risk to the UK financial stability. Okay, so I think it's that fire sale dynamics statement that's causing us to hear the thunder and feel the lightning strike, right? Because they wouldn't be saying that if they weren't really concerned. Then toss in the latest baloney from Vlad, threatening more missile attacks on Ukraine as he ramps up his attack on that country, never mind his threat to use nuclear weapons, further escalating the geopolitical tensions that exist not only in that part of the world, but really around the world. And it's no wonder that the markets remain jittery, with the path of least resistance being lower and not higher. Now, nervousness causes many to hit the sell button. Remember that, right? But there's always someone who's ready to hit the buy button because there have to be two sides to every trade, a buyer and a seller. In this case, the buyers are in control as they step back and they reprice the risk that they're willing to take, leaving sellers to have to settle for lower and lower prices. But remember, this too shall end. The question now is, when will it end, right? Because it doesn't feel like it's ending anytime soon. This morning, U.S. futures are lower, although not as low as they were in the middle of the night, right? When I first started writing this note. At 6 o'clock, the Dow was down 250. The S&P was lower by 35. The NASDAQ was off by 105. And the Russell is down by 17. And I understand even since then, they've come up even a little bit more. I don't have them in front of me. Treasury yields are up again, and that's putting more pressure on stocks. The 10-year and the 30-year both are now rubbing right up against 4%, while the 2-year is yielding 4.33. There isn't any economic data to report that's going to move the markets today. So the focus is on tomorrow's PPI and the Fed minutes, and then Thursday's CPI, and then Friday's retail sales numbers. In addition, tomorrow's going to bring us Pepsi earnings. And while the market doesn't count Pepsi as the kickoff of the season because it's not a Dow stock, let's see what they have to say about the State of the Union, the strength of the dollar, and the role that is playing in their guidance, because I expect that the strong dollar is going to be an ongoing focus this quarter and next quarter and the quarter after that if it continues to rise. Speaking of the strong dollar, it's stronger again this morning, right? It's up 10 cents at 113.26 and likely going higher. And that's going to continue to put pressure on stocks. Oil, which shot higher after the OPEC news last week, has taken a bit of a breather this morning. It's down $2 at 88.94, leaving it solidly in the 87.22, 93.20 trading range. Gold continues to come under pressure thanks to the strong dollar. This morning it's down $6 at about 16.70 an ounce, 16.69 an ounce. The S&P last night closed at 36.12, down 27 points after testing the September 30th low of 35.85. Futures action this morning is testing that level once again. At 6 a.m., the S&P futures, which are down 35 points, are kissing 35.90. It feels like we're going to break that today and create another new 2022 low, and that is not going to help the psyche at all. If it fails to hold on to that low, then brace yourself for an even lower low, right? We're back at levels not seen since the collapse of the markets in October of 2020, between the 3rd and the 30th of that month, which saw the S&P drop by 8%. Today is October 11th, and markets have been under and are under pressure. And while I'm not trying to be superstitious, October 19th is only 1 week away. And the mood feels eerily similar to my experience in 1987 and many others, when many of you weren't even a twinkle in Daddy's eye. In the weeks approaching that day, that year, the market kept coming under pressure, moving lower and lower and lower until it broke. Remember, I started raising a warning flag last November about what rising rates meant and how it felt similar to the late 70s. And in August, I warned about the coming seasonal weakness. So I guess now all I have to say is brace yourself for impact. Anyway, okay, so let's move on. What are we having for dinner tonight? Oh my God, the Sicilian TBone. This is delicious. It's different. You don't do this on the grill. You do this under the broiler. It's simple. It's easy to make. But once you try it, then it'll become a family favorite. So you need 1-inch T-bones. You want them on the bone, right? You want crushed garlic. You need olive oil, fresh grated Parmigiana cheese, oregano, breadcrumbs, and pepper. You don't need enough. You don't need a lot of salt because the cheese is salty. You want to add a little bit of salt, go ahead, but don't add too much. Set your oven to broil. Set the rack on the second level from the broiler. Don't put it right up against the broiler. Begin by marinating the steak in garlic and oil, making sure to massage the steak on both sides so that it's well coated. Do not drown the steaks in oil, just enough where it's got a nice glisten to them and you've massaged it. Now, in a separate plate, you want to combine your breadcrumbs, you want to add the Parmigiana cheese, the pepper, and the oregano. You want to mix it well. Now you want to take the T-bones that are all nice and got the oil all over them. You want to dip them in the breadcrumbs on both sides, right? Get them nice and coated with the breadcrumbs. Now place them in the broiler. underneath, place them in the pan underneath the broiler. Depending on how you like it, you want to cook the steaks turning only once halfway through. So depending on the thickness of your steak, it's about 10 minutes for a rare steak, so it's 5 and 5, 14 minutes for medium steak, and 20 minutes for well done, right? I kind of like it in the middle there, medium. You want to remove it when it's done, place it on a plate, and serve it with a large mixed green salad, either a baked potato or roasted potatoes or something like that is always a great addition. And you want to enjoy this with a nice, robust, full-body red wine, maybe a Brunello di Montalcino, which is like velvet and goes down really easy. In any event, look at this. The sun is out. You can see how it's almost like a rainbow in the back of me. See it right there, this rainbow? And the sky is blue over here. So it's absolutely another beautiful day here in South Florida. Until tomorrow, take good care.